Well, hello, good morning, and welcome to our latest Bath Life Business Surgery. This time it's about private client and personal financial planning. Today we'll be exploring getting your house in order for 2021. So various areas of inheritance, of gifting, of CGT, of pensions, of saving, of business assets, LPAs, for those who don't know about lasting power of attorneys, and the importance of planning. It's in conjunction with Mogers Drewett, and its integrated legal and financial approach. It'll be with the Mogers Drewett trio of David Hill, Rebecca Beresford, and Stuart Doughty. So here we are on the very first day of the last month of a pretty bloody awful year for all of us, which we'll be glad to see the back of. It's time to get planning for next year. We can at least do that. Whatever else we may not be able to do, we can start planning our personal approach next year, and of course our business approach, and getting active in both cases. A few parish notices before we start. We're delighted to say that the Bath Property Awards have been transformed into the Bath Property Symposium, headline sponsored by Mogers Drewett. It's an ambitious and creative new approach aiming to deliver value and engagement to all in the property sector. 3 stages: thought leadership with keynotes from national level speakers, networking, unique sponsor-led hubs, like a cross between Bath Rugby and a trade show. Imagine that conceptually. It's really important that all of us get out there virtually this time, because there's no out there otherwise to get to, but to build our business contacts and relationships. And it'll be a unique opportunity for that. And of course, it'll culminate in the excellence strand, which is the awards themselves, live presented with drop-in inserts from our sponsors and then live reveals of our winners. It will be great. That's March 12th. And subsequently, there'll be an exclusive real-life event only for those delegates and sponsors and finalists who attend the Bath Property Symposium, March 12th. Big shout out, of course, to Mogers Drewett once more, to our headliner, but also our other sponsors, APS Homes, Hawker Joinery, L&C Mortgages, Spaces, so that's Regis, SWBF, and Triangle Networks. Please talk to us about how you can get involved, because it is going to be such a powerful session for any form of professional service, essentially, particularly those with focus on property. The nominations for those close on Thursday, the 10th of December, so that's next Thursday, a week or so away. Our other grand awards, of course, the Bath Life Awards. They're taking place this year on the 27th of May at the Assembly Rooms once more. As uber glam as ever, we actually want to uber glam them up, if that's a thing, it will be. Because this time round, this year of all years, there's never been a greater need or an opportunity to come together and celebrate as joyously as we will all do on the night of the 27th of May. Nominations will open in the new year, and we'll also have, there's a new thing, we'll have a Bath Life launch event, which will be running earlier in the new year. It's a special event, virtual of course. It will include all our sponsors who are in place by then. So, there's an extra sort of reason to come on board. Our current roster of sponsors, led very much from the front by the Royal Crescent Hotel and Spa, plus Apex City of Bath Hotel, Bath Audi, Marsh Commercial, Minuteman Press, Novia, Savills, Spaces, Stone King, and also Hotel Indigo, and some outfit called Bath Life, inevitably. We are, of course, aware in both awards cases that this, whatever euphemism we apply, hasn't been the best of years. It's been pretty horrible for most people in different ways, of course. And so there may be some reluctance about nominations, and we do understand that completely. The truth is, everyone's been in the same storm. There won't have been quite as many standout performances. Some sectors have done really well, but many sectors, of course, won't have been. But this is your chance to put your case forward. And to be honest, if ever there was a time to stand up for your business and your team, it really is after this year, because the sense of bonding that this year has caused, it's one of the few positives that's emerged from it, has been so important. So please look out for that nomination. And we'll have a question about the pandemic and your individual business's response to that. Of course, talk to us about sponsorship for either. It is an important time to help build or rebuild that business pipeline into 21 and beyond. We can't do anything about the past, none of us, but we can maximise our opportunities going forward. And that, on a personal side, is what is going to be talked about today. But on a professional and business case, all of us are thinking about how to get back in the game fully in 2021. A couple of forthcoming business clubs and surgeries. Look out for our next Bath Life Business Club on the 14th of December. It's a very special one. It's about charities and Christmas. Our charities always matter, been a key part of any city's life, but particularly in Bath, where there's a great concentration of people who are doing good and trying to help all others in different areas of our society and so on. They always matter, but this year matters more than ever. At a time when they've been denuded of funding, the shops haven't all been open, they clearly have not been able to run fundraising events, but the need has been ever greater. So join us on the 14th of December to hear more about some of the charities of Bath, how they've been responding and how businesses have been involved. Also look out, first one of the new year, which will be the Bath Life Business Surgery on 20th of January. That's with Juice Recruitment. And all of us in business, and recruitment is a key professional skill, all of us are looking for advice and insight. So join us for that and look out for any other business surgery. If you've got a professional service offering, a skill which works for other businesses that you want to show, share case and so on. Share case, is that a thing? It isn't. Then please talk to us about business surgeries. Lastly, thank you very much for your continuing support for Bath Life. We really, really do value it. We value what we hope is our role in the city of celebrating the greatness of the businesses, the organisations, the individuals, the charities, all the different civic aspects of what makes Bath so very special. And it's a mutual relationship. Your support for Bath Life enables us to do that, issue in, issue out. There's a new initiative we've started in the last couple of weeks as a thank you to our advertisers, but also to help keep awareness and help generate business. We've been supporting our advertisers via a social media campaign, Tweet Out to Help Out. It's a homage to Rishi Sunak, promoting your support for Bath Life. It's Insta and LinkedIn as well as Twitter on that, and sending out an email to all of our database thanking our advertisers. So thank you for that. Right, to business. Let's bring in shortly our Mogers Drewett trio. I'll be interviewing David Hill, Rebecca Beresford and Stuart Doughty on your behalf. Please send your questions in using the Q&A button at the bottom. You can ask anonymously if that works for you, because some of this may be very personal or private or whatever. This session will be recorded as ever and published on our YouTube channel, the Bath Life YouTube channel, later this afternoon. And please then share that if it's valuable. Let's bring our speakers forward if we may. And as they are stepping up to this virtual plate, let's give a little detail of them each. David Hill, partner and head of department for Mogers Drewett, is a fellow of the Chartered Institute of Legal Executives, lots of capital letters there, member of the Society of Trust and Estates Practitioners, and yes, partner and head of private client at Mogers Drewett. Over 30 years, he's developed extensive experience in all aspects of estate administration, specializing in complex estates, tax mitigation, wills, estate planning, lifetime gifts, and variation of estates post-death. Highly experienced, and we'll come on to several of those issues shortly. Rebecca Beresford, partner in the Specialist Trust team. Welcome, Rebecca. Advises on creation, administration, and winding up of trusts, both from tax planning angle, but also the use of trusts for succession planning and protection of assets. Advises on wills, estate planning, powers of attorney, regularly dealing with agricultural estates in particular, in terms of drafting tax-efficient wills and succession planning for farming clients. And Stuart, and we'll be talking about this, about the integration of legal as well as financial in the offering, which is, I think it's fair to say, I think it's unique in Bath and pretty rare in legal practices across the country. Stuart's background is very much financial, has worked in banking and finance since '85, a very experienced man, has advised clients since 1992, blue chip experience with Barclays, Aviva and Eversheds, prior to moving to Cavendish Grants in Bath in 2001. Focuses on relationship-centric private client work and long-term management of post-settlement personal injury cases, PI as lawyers call it. Away from work, he chairs Bath Rugby Foundation as an ambassador for Triactive. Well, let's good morning to you each. Hope you're in good spirits. Let's start with Mogers Drewett as an entity. Many professional services have actually fared pretty well in this year of the pandemic. Business in these times for you, how's it been?
Well, I think yes, we're still here, which is a bonus. We've had the pain that everyone else has. We're not immune to it. We went through the furlough at the early stages. Thankfully, we've got everyone back out of that, and we've juggled with the working from home and not being in our usual environment, and the difficulties that brings both at home and at the office, and not having the usual interaction we do with the people that we've been used to seeing every day, which is the human element. And again, I think we've all experienced that to one level.
We've all had that. On the one hand, the sort of lack of social glue which teams and offices bring, but also the less ability to build relationships. But I wondered how you're, as a team, how you're viewing 2021. Is it sort of cautious optimism, or do you just simply don't know?
Cautious optimism, I think, is definitely the way we're looking at it. We're quite strong in the private client element, and that's something that we're finding most of our clients are wanting some reassurance, some advice, even if it's just a hand on the shoulder to say what you've done is good and it still holds water for the future. Reassurance is a huge element in these difficult and unsure times, really.
Talk to us about this this integrated offering, which we will explore during this discussion. I mentioned before, it's rare for a legal practice to have this offering with the financial advice as well. What was the rationale for it?
It was born out of listening to clients. Clients that they were telling us they wanted convenience. They liked the trusted brand that we have. Fits quite nicely with other things that we do as a business, which are not necessarily strictly what you would bring under the umbrella of a law firm. We have an HR offering, for example, so it fitted quite nicely with our ethos and our constant strive to service the clients and grow as a business too.
So, I mean, the advantage of that integrated offering, one can imagine are reasonably clear, and you've expressed some of them here. But what about any disadvantages?
I think one of the things that we wrestled with when we were looking at this as a concept for us as a business is the existing relationships that we had with other IFAs. We still have really good working relationships with most of the ones that we did before. Obviously, that's changed. But it's working within that and giving the clients another option, really, is what we wanted to do.
And Stuart, maybe some of the comparisons and differences between the legal and financial worlds as you've experienced them from a sort of personal, professional basis.
I think it's about upskilling, Greg, because at the end of the day, we're not lawyers, stating the blindingly obvious. So it's understanding that operating the law firm, what that looks like. And I think as an industry, financial services has gone from the sort of cowboys of 1980 to being over-regulated now. But financial advisors have been incredibly busy, ones that are relationship-based, certainly in 2020, and it's set to get even busier for 2021. So being more professional, which is being more like an accountant, more like a lawyer in terms of your time recording, your efficiency, profit, rather than our old-fashioned industry, which was charging a fee on the percentage that somebody invested. Thankfully went out with the dinosaurs, and now we're very much time-based in keeping, obviously, with our legal colleagues. So that's been a big learning for us. We're still not as efficient as our colleagues, but we're getting there. So that was one of the attractions for us for self-improvement, effectively.
And in some respects, I mean, it's not as diametric as this. In some respects, you've moved from a world which is more product-based, perhaps, into more service-based. How has that been? And how do you, when you're not, perhaps in a prior time extolling the virtues of a product, you're trying to inculcate that sense of trust when it comes to a service?
Yeah, and I think that was, if I'm looking with David's hat on in terms of integrating a new financial planning team that's a non-legal activity. Mogers Drewett, it's now 200 years old effectively as a firm, so the trust and establishment in Bath is absolutely huge, and we're incredibly aware of that. For us as the people that we've employed, it's never been about product. Product is a byproduct. So at the end of the day, it's what are we looking to achieve? What are the objectives of the clients who have quite clearly come to Mogers Drewett first and foremost for a legal need, but actually with the questioning that the lawyers can provide, the relationship can expand into other areas, and it's seen as a natural dovetailing, joining at meetings, etc. So it's been a very exciting time, challenging obviously in terms of from a COVID perspective for all of us, but I do think because clients, and we spend most of our time on the private clients side, although we do corporate work as well, people are really examining what their goals are, what their values are, and that's led to a massive re-examination in client size, what they're looking to do, their timeframes, etc. So therefore, if you've got a professional financial planning team, cash flow modeling, which is a bit of a gimmick, I have to say, 10 years ago, it's an extra tool that people thought they could just use with a bit of colour here and there about charging extra fees. But if done properly, and most firms in Bath do that, is a really good mechanism to, am I still on track for my goals, given the fact that my time horizon, my desire to help my children and my grandchildren may have changed. How does that affect me? I mean, there was an article.
Let's come on to that and ask as a an intro to it to Rebecca about the importance of planning. Everyone says it's never too early to start planning, but is that really the case? Talk to us about why planning matters.
I think it is the case, and I have to say, I think that's been the experience of the global pandemic, that it's really focused everyone's minds on, is their planning up to date? And so we, in the private client team, certainly been very busy working with clients to look at the plans and refine them. I think what we see an awful lot of is people getting to the sort of age where they think it's appropriate to start thinking about putting their affairs in order, and suddenly we're trying to unpick things that actually maybe the ownership of assets isn't in the right place, the policies aren't paying to the right people, the nominations that have been put in place. I mean, plans will always change and they've got to evolve, but I think it's really appropriate not to kind of think, well, planning's for then, but actually at every significant stage to hold it up to the light and say, well, is it fit for purpose now? Or is it going in the direction that actually that's the general direction of travel for us?
Yeah. And do either you or your colleagues, do you think there has been have you experienced an uptick this year, perhaps with increasing thoughts of mortality for all of us one way or another?
Yeah, absolutely. So we've had a phenomenal number of clients reviewing wills and just looking at, and I think Stuart would probably agree, adjusting timeframes in terms of saying, well, actually, I'm going to reorder priorities here because we've suddenly seen that life is a bit more precious than perhaps we had the time to stop and think about. And the lockdown has sort of given everyone a bit more time in some cases to actually reassess things. So I think there has been a lot of desire to plan.
Would you be able to talk through, I mean, clearly without naming anyone for client confidentiality purposes, but an example of someone who's come, and I'd like to come into the life stage point as well, for you to talk with those watching about, what are the concerns which, I don't know, 20-somethings, maybe 30, 40, 50, 60-somethings are having. Perhaps give us an example of someone who's approached you this year with a sort of volte-face in their life about how they're thinking about their own personal financial destiny.
I think it's what's come to the fore, and I'll stick to your category there, Greg, of 20s, 30s, but actually somewhat 30 years beyond that, it's also affected me in terms of our impending house move, is that the need to have access to a decent mortgage broker. I mean, it's one of the few services that we don't provide as a financial planning team because it's such a specialism. Therefore, having a link broker has never been more important, because with the CBILS, with the coronavirus loans, etc., lenders were virtually paralysed in terms of their ability to lend successfully. So their default was no. If you were self-employed, it still is a disaster, to be honest, out there at the moment. So therefore, the only way to successfully navigate is not the Sunday papers and the Best Buys, it's to have a mortgage broker that understands the market, because unless they've got the ear of an underwriter, then at the moment, you've got next to no chance of getting that application through. And I don't mind citing my own example of having been with a high street lender for 13 years, having never taken a mortgage holiday, having to reduce my mortgage, choosing to reduce my mortgage because we're downsizing and helping the kids. It was the Spanish Inquisition. And I understand this industry, and I've been in it, as you say, since 87. I was appalled at the way lenders were taking a sledgehammer to the process. Look, if I was a 20-something now, and one of my colleagues, his son is going through this, and thankfully we've put him in touch with a mortgage broker who understands the marketplace, but it is shocking out there at the moment. And that needs to change. That needs far better regulation and protected, because they operate in a tick box world, and we know we're not in a tick box society anymore. So
is the shorthand of that a bespoke approach is inherently better than that larger scale high street approach? Is that what the point looking here is?
a bespoke, and also building a story that, it's not just things are affordability driven, and they haven't been asset driven for years. So whilst the bank and mum and dad are looking to help their children, you need a good mortgage broker to explain that carefully and accurately, which somebody in their mid to late 20s is not conversant with doing. Again, it's a changing marketplace. So bespoke, yes, but you need an expert. And bear in mind, an expert mortgage broker will only charge probably 200 or 250 quid for their services, because they're getting paid by a lender. So it's not an expensive service, but it's become an invaluable service we've noticed over the last 7 or 8 months.
Let's go through the life stages, whether it's getting on the property ladder as far as can be done, given valuations and so on, in perhaps mid-late 20s, well into the 30s. When clients come to you, what are they looking for? What are their planning stages in their 30s, 40s, 50s, 60s? What's on their time horizons?
I think people have been so busy, Greg, to be honest, they almost don't look at this stuff normally between Christmas and New Year. Whereas now it felt like Christmas and New Year started on March the 23rd. So people are looking to review things a lot more closely now and really challenging them. Have they got the detail themselves? Invariably, that's a no, as Rebecca was alluding to. And because there are greater demands from the boomerang generation in terms of our children returning home, how can we help them? Because we're all desperate to help them at the same time as 33% of over 55s are living beyond their means in respect of that. Was the latest figures 12 months ago from FT Advisor. So unless you stress test that in terms of what does it mean for me if I start gifting to my children. So there's no doubt there's been more questions over the last 8 or 9 months. How do I help? How do I contribute? Is it gifting, etc., charity? Lots about how I help in the community financially, but how does that impact on me? And starting with a true audit of what a client has. When a client comes from David or Rebecca or the private client team, understanding what they've got first before dashing off, as you say. It's not about a product, it's understanding where somebody is. And quite often there's a disconnect between what they've actually got and what they think they've got.
Let's come to that audit in a second. I just want to make a point to those watching. Please do ask questions. We can take them anonymously. We don't know your names if it's at all, much of this is very private. But this is an opportunity free to ask experts in their field about how to begin to put your own financial affairs in order. But back to that audit point, do you talk us through how that works? So someone came to you and say, whatever's triggered it, presumably coronavirus, sense mortality, whatever. What does a personal audit look like? Do you even use that expression?
Behind closed doors, yes, because you say it's a bit formulaic. It's just a desire to understand that we've all got goals, and it's understanding financial planning is purely an enabler for people to achieve their goals, and for us it's about managing risk, taking as little risk as possible. So it's finding out the details on the pensions and the life policies, everything, and all the investments, to understand exactly those details and making sure that they're fit for purpose. And what we found, particularly over the last 4 years, since the pension changed in April 16, is that people's expression of wish forms linked to pensions, which is not time bound. I mean, if you've got a pension, you should have an expression of wish form nominating beneficiaries. Invariably, they're not structured properly. So this isn't a cost effectively, because all pension companies provide these expression of wish, but there's just not the provision or the awareness what that means for spouse or children.
Could you give an example of that when inevitably we're moving into slightly more technical areas? Expression which will be a phrase which perhaps someone heard of, but where are they not appropriate? Where have people not thought about the sort of futurity?
I think it's a good question. I think people think about, well, they're my children, so therefore they'll benefit. In pensions law, they don't, in terms of, it's very simply, if your name's not on the list, you can't come in, as a view we look at it. So in terms of if they're not nominated, they get to a certain age, and in pension law, that's 23. So I look at my daughter, who's 26. If I don't nominate her, just because she's my daughter and I'm still paying for education, she doesn't get anything from my pension. So whereas people say, oh, don't worry, I want my wife and my 2 children to benefit, and I do, but unless I've written that down, that's the important thing, and I've reviewed that in the context of with my lawyers as well, then is it fit for purpose? Is it joined up with my will and my lasting power of return as it should be? So very simple housekeeping point that people should look at, because with the pension rules as they are, the fact that, and I've had 2 cases of like this in the last 12 months, if death occurs before age 75 of the pension holder, then if it's structured properly, the monies can pass tax-free to the nominated beneficiaries. So you've got a lovely tax-free pot, which can therefore almost like become like what we used to call a trust fund of yesteryear, and will go on in perpetuity, subject to having a value. So just that simple structuring.
Can you, I mean, you're obviously extremely familiar with this, others listening won't be. Can you just dwell on that point, that if it is structured correctly, if death occurs before, but sorry, after 75?
Before age 75.
Sorry, before 75, assets can pass tax-free. What is not structured correctly then? What might that look like?
Well, let's just say that I wanted, in my case, that to go to my children and not my wife. But actually, I put everything to my wife. So at the end of the day, it's making sure that actually the right destination is there. I had a case recently where the lady her godmother passed away, and she didn't have any children. So she realised, whilst it was sad that her godmother passed away, she was nominated under her godmother's expression of wish, and she's now the recipient of a £120,000 pension fund, which is not part of her own pension allowance because it's disregarded for those calculations, and will be tax-free unless they change the rules. So our job as financial planners, working with our legal colleagues, is to make sure that people are aware of these situations and they plan accordingly and take the appropriate steps.
Let's thank you. Let's come on to wills and trusts. Perhaps Rebecca, you could give us the distinction between wills and trusts, and when one might more typically go the trust route rather than a normal, quote, normal will.
Well, a will is obviously operative on death. So you make it in your lifetime, but it's of no effect until you've died. A trust can be created at any time, either in your lifetime or through your will. Trusts are quite often used for lifetime tax planning. It's a pot. So we create a trust. We have trustees who control the assets, and we have beneficiaries, and they're the people that benefit from the assets. And it's a way of passing assets, usually down a generation at a time that's appropriate, but not actually giving them to the next generation. Now, that might be because they're young, because they've still got a few reckless and feckless years in them, who knows. They might have some marriage concerns in the future that perhaps we're waiting to see what happens. Or it might be a question of identifying the right assets that we want to put towards a successor in the business, but they haven't quite yet earned their spurs. So it's a way of starting the process of handing the assets on, and obviously the person giving them is giving up any right to benefit from them, but we're not necessarily putting them straight into the hands of the recipient. So they're quite a useful tool, or they're a very useful tool in terms of planning. Trusts have a particular advantage and disadvantage in that if you create a trust in your lifetime, it's chargeable to inheritance tax immediately if it exceeds your nil rate band. So on kind of basic terms, if I put more than £325,000 into a trust, then I'm going to pay an immediate tax charge at 20% on the surplus. The advantage, because we've got that inheritance tax treatment, is that we can hold the gain over if there's a capital gains tax point. So with assets that you give away, if you're giving them, you would normally trigger a capital gains tax disposal. If you put them into a trust, you can hold that gain over. So if a married couple, for example, had got a rental property that they wanted to pass down a generation to children, and let's say it was worth 600,000, if it's in the joint names of husband and wife, we can put it into that trust, hold the gain over so we don't trigger that CGT charge, and start our 7 years running for inheritance tax planning. The income can then belong to the children and be taxed on them, and it's an efficient route to get assets down a generation, perhaps for the kids then to pay their own university fees using their own personal income tax allowance, against that rental income. So that's quite a good way of using a trust. The other point is that transfers into trust that attract business or agricultural property relief, you can put any value into the trust provided it's exempt when the assets go in. So there's quite a lot of planning going on at the moment, because there's a lot of talk. Obviously, we know Mr. Sunak's got some money to raise from somewhere. So there's a lot of talk about what might be on the horizon in terms of tax changes coming up in 2021. It's a very difficult space to plan in, because of course we're second guessing, we don't know. But there are clients coming to us and saying, well, actually, we could afford to do this at the moment. It would make sense. And just in case the tax rates or the tax regime changes, this would be a sensible route to go down.
So in what circumstances would someone watching this think, well, you know what, that sounds great, but my financial affairs are not as complex as that. I'm happy with just a will, an ordinary will with essentially off the shelf with bespoke detail and so on. Why? At what sort of level of complexity might the trust offering begin to make more sense than a quote normal will?
Well, particularly if we've got clients with business assets where they would attract relief from inheritance tax. So shares in an unquoted trading company or a partnership interest will attract 100% business property relief, and that's quite valuable. So if you've got for example, a married couple or civil partners where one has the business assets and is the driving force behind the business, let's say that business is worth £1 million. If they were to die, the chances are probably that the surviving partner would sell the business. And then the surviving partner will have the cash proceeds of £1 million in their estate, which is going to be potentially taxable to inheritance tax on their subsequent death. So there's a good argument for saying, well, actually, let's capture the availability of that relief in a trust in that will on the first death. So nothing has to happen now. Nobody gives any assets away now. But if the business owner dies, their interest in the business goes into that trust and we capture the inheritance tax relief. The business is then sold and the proceeds belong to that trust, and they can be made available to the surviving spouse for whatever they need, an income or assets lent to them. But we haven't put that taxable value into the estate of the surviving spouse for their subsequent inheritance tax bill. So there's some good planning for business assets on the first death where you've got a couple.
We'll come back to business assets in a moment. So we've just had a question from John Cullum, and I'd like to sort of bring him in virtually, as it were. He said, I believe there is still quite a degree of scepticism, and this is more for you, Stuart, a scepticism where independent financial advice is given, but there are often commissions linked to the same service providers. How did Mogers Drewett handle this potential, he stresses potential, conflict of interest when deciding on their integrated offering?
That's quite easy, Greg, in that respect, because whilst we are independent, there is no conflict in that respect, because there's no inducements. What is a concern in our industry is that the regulator seems to want the largest organisations rather than the smallest from a regulatory perspective, and therefore is encouraging independents like ourselves to actually deal with fewer companies. And if we deal with fewer companies, there's better economies of scale and benefits for the client. At the end of the day, is that we charge on a time spent basis, end of. So the products have got nothing to do with it. All the products are clean. So my fee is my fee. It can come from the product. It doesn't come from the fairies at the bottom of the garden. It either comes directly from the client as it does with Rebecca and David, or it comes from the great thing is that's the client's choice. It's incredibly transparent. And even though our industry changed from memory, the 31st of December 2012, when the retail distribution review came in, we were already doing that. We were already that transparent. These are the charges. How do you want to pay? Whether you want to pay from the product or pay directly, it's the same fee.
So, I mean, one other way of putting it, it comes back to the question of the difference between service and product. And in that respect, you're not selling a product, you're selling a service, and you're charging for your service. And there's no commission that is correct.
Unfortunately, financial planning industry, there's no actual league table. I wish there was, Greg, but the probably average initial fee is something about, say, 3% of the amount invested, and they charge between 0.75 to 1% a year. We don't get into that. We charge on a time spent basis. So the more we do, the more we charge, and that's the consistency of working within a law firm. Whereas our industry can be they can charge, if they've got £1 million to invest, they'll charge 10 times as much as they would for 100,000. That doesn't wash with us. It's about the work that's involved, not about the product or the value.
And again, perhaps in layman's terms, you're acting within the sort of strictures of a legal company whilst having financial expertise. That's
absolutely. Yes. Yeah.
Okay. Let's come back to business assets. So just again, I mean, obviously all cases are different, but talk us through which a number of people we know are going through this process of considering selling their businesses. They've, maybe it's life stage, whatever. How does that play into putting assets into a trust? How does the timing of potential disposal of assets fit with taxation planning?
Well, you might want to think about if it's an opportunity to pass some assets down a generation through a trust, you might want to consider putting some of those business assets, so a proportion of the shareholding, for example, into a trust in advance of any sale. The advantage of that is that you're not limited to that 325 I spoke about previously. If the assets attract relief, then you can put as much as you want to into that trust in advance of the sale. It's important it's done plenty of time in advance, because if there's any contract in place, you lose the availability of business property relief.
Can you just absolutely clarify that point? When you say plenty of time in advance, is it that is prior to even beginning negotiation for sale, or creating?
No, that's not necessary, but obviously quite often clients come up with the right idea a bit too late down the line. As soon as there's any kind of contract in place, the revenue will say that those assets don't attract relief anymore, because in effect they've become the proceeds of sale as opposed to the business assets.
So the other way around, anyone contemplating, or even contemplating that they might be contemplating selling their business, they should figure the taxation in advance prior to that. That should be the first step prior to anything about information memoranda or advisors or analysis of business, let alone prospective buyers.
It's good to just have some thoughts about that right at the outset of the process. And there are pros and cons, because of course the tax on the disposal of the assets will be different for that proportion owned by a trust. So it's not always the right planning, but it's a moment of opportunity to say, well, actually, if we did this now, we could get £1 million into trust as opposed to being limited. Do we want to do that? And so, yeah, it's a really good opportunity just to look at what might work.
Right. And from a personal financial planning perspective, are business assets inherently any different from, I don't know, property or art or money, dare I say?
From a qualifying perspective in terms of tax, right, yes, absolutely. And as Rebecca said, it's about taking advice and understanding the options. I've had a couple of clients who, I guess it's been moved now, but we're making sure that their business sale went through before we were expecting Rishi Sunak to have his autumn statement, because they wanted to capture the current low levels of capital gains tax and make sure that entrepreneur relief, which they have as business owners, is intact. Thankfully, then they still got them done in time, but in terms of when they thought it was going to be. So, but that's a very generous tax break, but again needs to be examined properly about how you take something that is incredibly tax efficient, but it's a business asset. Once your business is sold, obviously it's moving into your personal name potentially, and therefore that has all sorts of inheritance tax consequences. So again, our job as a team is to make sure that a client understands their options and is aware about what is best for them, given their time horizon, given their risk, their comfort with risk, because they may be incredibly entrepreneurial and successful, but they're now stepping out of that business that they've just sold or about to sell. And then that becomes a worry, because they've now converted it into cash, and how do they structure it appropriately, especially in these incredibly challenging times.
And talking of incredibly challenging times, it's also, whilst it may be tax advantageous, it may also be a particularly duff time to be selling assets, because market values are in many cases quite depressed currently. Whilst there's a load of capital out there, valuations are inherently low in many sectors.
They are, but again, so it's sector specific. So there's some ridiculous values out there at the moment, and I'm having lots of conversations at the moment about negative interest rates. So, which seems bizarre. And I look at, European bonds, I look at short-term government, UK government debt, we're all either zero or minus. So, You'll have seen National Savings last week. One of their headline accounts, income bonds, has dropped from 1.15 to 0.01%. And that's the conversation I'm having now with business people, where people are sellers, because they're not concerned about interest rate, they're just concerned about credit risk. And that's where National Savings sits very well for people.
For those like me who find the concept of negative interest rates, could you just explain how on earth that works, perhaps in brief, if you may?
Oh, crumbs. I wish
or
I
not
could.
If it's too complex.
Yeah, it is quite. I mean, I think what we'll see. My take on it is this is about central governments trying to keep a lid on inflation. They're desperate, whether you're the UK or Europe, trying to keep a lid on inflation. Obviously, if we look at CPI as being inflation 0.9, so the Bank of England will look to keep that under control. Obviously, there's not much scope when the base rate is 0.1 already. But you've got 0.1. And you've got interest rates virtually of zero, which HSBC have come out with a paper this morning, which I've yet to read, on preparing for negative interest rates for next year. I believe banks could well do, because they don't need the cash. But I think because National Savings are backed by HM Treasury, I think you'll probably they probably won't go negative, but they will stay as close. They will be hugging zero for the best part of 2021. But at least, and I would say to any client, it's still your emergency fund. It's still safe. I think you've got that with HM Treasury, where you can hold 4 million in a direct saver and be fully protected. Whereas if I was with Nationwide or any other bank or building society, it's £85,000 per person per institution. So we're having a far more of a credit risk conversation now, and actually we were in 2008, 2009, the banking crisis.
But David, I'll come to you in a moment about LPAs and planning for perhaps into later life care and so on. Come to that in a moment. We've had an intriguing question from an anonymous attendee who I think might be called a buying signal. So try this. As this is a complex area, can anyone book appointments to discuss their existing plans with the experts to determine if they're currently correct and in line with future goals? You want a one-word answer?
Yes.
Yes.
Yeah, that person is anonymous. We do not know who that is. If Mr. or Mrs. or Ms. Anonymous would like to be in contact, then please do, because I'm sure Mogers Drewett would love to hear from you. LPAs, David, at what point, what sort of life stage should people consider having lasting powers of attorney, and just explain how they work and what rights it gives their siblings or whoever it might be?
Okay, probably best to start with the documents themselves. There are two types of lasting powers of attorney, came into effect 13 odd years ago. One deals with you as a person, that's a health and welfare power of attorney, and one deals with your finances. Both documents are similar in that you appoint and nominate one or more people to look after you or your finances if and when it becomes necessary. There's a slight difference between the two. With the health and welfare power of attorney, that can only come into effect once you've lost capacity. The theory behind it, if I'm going to have some medical treatment or there's some decision that needs to be made about me and I've got the capacity, I have to make it, and that's right. Finance is slightly different in that in the same way as you might go to an advisor such as Stuart and effectively hand over some of the decision making and advice to someone who knows. Power of attorney is similar. You can decide if you want your attorneys to do certain things for you whilst you have capacity. There may be many reasons for that. If someone's traveling, that's not really likely at the moment, but if in the past, we've had people who are in the forces, for example, who might be on a tour for a number of months, create powers of attorney so that their affairs can be managed whilst they're away. Some of us simply have areas of our lives that we don't want to manage, and that might be because we've got more important things to do, or we've come to a stage where actually I've done enough of that, I want to hand that over. It can be helpful, touching on what Rebecca was saying, as part of family succession planning, it's bringing family members into a business but not giving up control. And then you've got the other end of the spectrum where you can treat both of the powers of attorney almost like they're insurance policies. They're there to be called on and relied on if and when it becomes necessary. And like any other insurance policy, it needs to be in place before you need it. So if there's an illness or an accident, which means that someone's out of action, either temporarily or permanently, life still goes on, bills need to be paid, businesses still need to be run. So for all of us, I would say powers of attorney are as essential as wills, because none of us have got a crystal ball that's particularly reliable. Yes, it's just part of good planning to have every angle covered. You choose who you're going to have look after things if you can't do so yourself.
And how do you help families, or you know, I don't know, the mother and father of families, as it were, when it comes to the reluctance to cede power of attorney because there's a fear of loss of control, or in some way they might be taken advantage of?
Yeah, well, there's two levels to it. As I say, if focus perhaps on the financial power of attorney, because that's the one where most concern usually is. Whilst any of us, if I create a power of attorney, whilst I've got any degree of capacity, I remain in control. So if someone I've nominated to help me is going to do anything, it's going to be with my instruction. So that's the first part. If I've lost capacity through an illness or an accident, then the attorneys have to have a degree of autonomy, and they have to do what's best for me. And that's apparent both within the act that created the powers of attorney, which most of us will never read, let's be honest, but the document itself is quite clear that if I'm acting for someone else as an attorney, I've got no choice and no leeway to do anything apart from what is best for them. So the typical thing that we get when we're talking to generally parents is, okay, well, what if my son or my daughter decides that they want a new car or a new house? Can they use my money to do it? And the simple answer is no. An attorney can't benefit themselves, no matter who they are, whether it's a professional or family member. And if they do, then they can be personally liable for the loss. So there's quite a strong backing. And this really goes to the ethos of why we now have lasting powers of attorney rather than what was enduring powers of attorney, because the system previously was far too loose. So the reason we have this relatively new legislation is based purely on protection. And as I say, if you look at any of the paperwork, there's no doubt that the thrust of it is looking after the person who, as you say, is giving up quite a lot of freedom and right in certain circumstances, and an element of trust. And that's part of, again, the process is you choose who you are going to appoint. And
what's the consequence of not having that? How does it work in terms of if there is no lasting power of attorney, someone lacks capacity? What options at that point for a deputyship, or is it that potentially that someone would eventually die intestate, and there's different problems with that?
I mean, there's a cut-off point, quite as Rebecca mentioned earlier, that powers of attorney act during lifetimes, wills or the intestacy provisions follow death, and the time of death is an absolute cut-off point. The two don't cross. So with with power of attorney, if you don't have it and you lose capacity, at that point, pretty much everything stops, because no one has an authority. If it's me, you know, my wife doesn't have any authority over any of my own personal accounts or anything else. She goes to the bank and they'll say, sorry, you're not David, so we can't talk to you. There needs to be this piece of paper to link whoever's looking after your affairs to replace you. And you mentioned it, if there is no power of attorney, then there is an alternative. It's the deputyship. It's through the court of protection. Probably that's where the similarities stop. The positive is that there is an option. The negative is the amount of time that it takes to actually get in the position of being able to make a payment, to pay a bill. We're talking months, and at the moment all the courts are under pressure, so you'd be lucky to see any movement within 6 months. Cost is also relevant. You're probably looking at 5-10 times the cost of getting a deputyship order as you would of creating a power of attorney. You've got the upset and the heartache that goes with it. Why would you impose that on a family member? And then the second part is how the deputyship actually works. What happens is that the court appoints someone to carry out their instructions. So even if you are a spouse and you're looking after, a family member who's lost capacity, which is going to be pretty stressful, let's face it. If you're in that situation, there's the human side to it. You effectively have to go cap in hand to the court every time you want to do something, ask their permission to do it, and then be told yes or no. And then every year you have to report back to the court to say that what you've been doing is correct. Now, in one sense, that's an extremely safe and secure process. The other end of that spectrum is incredibly invasive from a family's point of view, expensive and very, very slow. And life isn't a flat line. You can't always wait for a decision.
So just to recap, invasive, stressful and slow versus get an LPA sorted.
Yes, pretty much.
I have to say, even with my sort of feeble approach to things, I think I could work out which is the better route. What happens if someone dies without a will, or at least a fully extant or recognised or authorised will?
Well, you mentioned again is the intestacy provisions, and I'm afraid that there is jargon in all of this, because you say intestacy to most people in the street and it sounds actually quite rude, but what it means is it's where the law determines what you would have done, and it's a saying for all of us. It's following down your next of kin from a legal perspective. Now again, next of kin can be something that's a bit of a grey area, because if I go into hospital for an operation, I can nominate a next of kin. I can say who my next of kin is as from medical purposes. But as far as inheritance is concerned, that's completely different. If you're married, your next of kin is your spouse. If you don't have a spouse, it will be your children. So it goes down the literal bloodline. If you have no children, it goes up the bloodline, so through to parents, and it can be uncles, aunts, cousins as well. If you don't have any relatives, which is unusual, then locally for us in Bath, Prince Charles is going to be your beneficiary, the Duchy of Cornwall.
What?
And he's a bit down on his luck at the moment, so probably could do with a few quid. But no, seriously, there's two parts to it. Again, if we look, there is a comparison with powers of attorney. It's far easier for anybody in those stressful circumstances of having lost someone to have a will. A will isn't really nothing more than a set of instructions. If something happens to me, this is what I want you to do. If you, and again, there's a similarity between that and powers of attorney. If you have a will, you appoint executors to carry out your wishes, and your executors are in place as soon as you die. There's a probate process to confirm it, but you have executors. If you don't have a will, no one is in place until someone's made an application to the court to deal with the administration of your estate. So there can be quite a period of limbo when no one has any authority to do anything. There's again, for us as humans, possibly just because we're English, we don't like to talk about these things and we like to pretend that we're infallible. I think that the last 6-8 months have told us that that's not the case for any of us. Make a will, keep it as simple as possible. Just don't avoid it. You get the peace of mind of having done it. You're getting your affairs in order. It'll probably trigger a number of other things that will be useful, you're saving the heartache for those that might be left behind. And you'll stop people like me badgering you, saying, "Get on and make your will."
You say that many people don't like talking about death and such awful matters. People also don't like talking about money, but let's talk about money very, very, very roughly, insofar as there's a typical. What would the range of costs of a will typically be in a fairly normal type of estate that someone might have?
In broad terms, you're probably looking at somewhere between £300 or £400 at the bottom end, up to. I'm not saying the sky's the limit because that sounds awful, and I don't want to turn us into typical lawyers. But you know, if you have a very complex set of circumstances, it's right and appropriate that there's the right amount of time and effort spent on it to produce something that is right for you. So, okay, sometimes we're making wills where the cost can be, you know, a couple of £1,000s. They are unusual, but as Stuart was saying, with any advice, the costs follow what it is that's needed, and I'm bound to say it, but it's usually money well spent, because without it, what are the consequences? The more complex the circumstances, to be completely blunt, the more of a mess you'll leave behind if you don't do it properly.
Yeah, which does happen. We're coming towards the end of this, but I just wondered on that wills point, there's a couple of things. One, of course, that wills can just be updated at any time, presumably.
Yes.
Perhaps life circumstance changes. But when would you, again, as far as it's possible to be typical, when would you advise people to be thinking or rather acting on a will? Is this something that, you know, you can just leave until your 40s, 50s or some such?
No, sorry, did you want to do that, Rebecca?
Yeah, I'll jump in there. This is something David and I talk about quite a lot. I think there are various trigger points that are really important. The first would be if you're buying a house with someone, and that might be, well, sadly these days it's probably not likely to be 20-year-olds, perhaps more likely to be 30-year-olds. But you know, what happens if one of those co-owners dies? How would you want your share of the property to pass? And I think there's a connection there to the financial planning, looking at mortgage protection. If one of the parties is going to die, how's that going to leave the other person occupying the property? I think it's really picking up on Dave's point about intestacy. What's really important to understand is that there is no automatic right for cohabitees to benefit under the intestacy provisions. They might have an opportunity to claim against the estate, but there isn't an automatic right for them to benefit. And that's a really common misconception, the common law wife, common law husband, that actually they're entitled to something. And so if people are cohabiting in a long-term relationship, really important that they put wills in place to look after each other. The arrival of children would be a next trigger point. And obviously, if couples enter into a marriage, whatever will they've previously had needs to be reviewed, because it will have been revoked by the marriage unless it was specifically made thinking about that marriage. Children, who are you going to leave them to? That's a big question. And I think probably the biggest reason young people don't make wills is they disagree about who inherits the kids. But obviously really needs to be thought about. And then it might be a question of accumulating wealth, perhaps business assets, looking at planning for those as you kind of get towards later middle age. And as Stuart said, looking towards providing for children in your lifetime and how that impacts on gifts in the wills.
Yeah. Okay, as I say, we are pretty much at the close of this. I wondered on a stand-back point, if after this year, as it comes to its dismal close fairly shortly, I wonder if you found yourselves being drawn into giving advice on less immediately or less defined legal and financial matters, such as quality of life or work-life balance. Are those sort of conversations you're having with clients?
Oh, very much so, Greg. I mean, I had one only literally 2 weeks ago, Mr. and Mrs. Both GPs, and they with 3 young kids, and it was, we are working 4 days a week and we're going to start to work less, because it was all about spending time with the children. And then, for me, it was therefore examining their NHS pensions and everything else, and they're protecting them at that stage of life. But that was a conversation, and we're having more and more conversations about that. The quality of life is no longer measured in just a pound sign or a euro sign. It's about time with family, time with friends, and making sure I've got enough, not lots, but enough assets to look after myself and those that are nearest and dearest to me. Yeah.
Well, we're going to close now. I'm going to ask you each if you've got any closing thoughts, points we haven't mentioned, or just points you'd like to reiterate for those watching. David, Rebecca, Stuart?
I would just go back to the point that was raised by one of the questions you had. Come and talk to us. Hopefully you've seen that we're not that scary, and we're more than happy if we see something that's okay, we'll tell you it's okay. Come and have a chat.
Come and have a chat. Rebecca, Stuart?
Yes, the same. It's always worth just reviewing things. And I think it's quite easy to think we've done that, we've ticked it off the list, nothing's changed. It's worth just a few minutes with one of us to just to say, well,
By the powers of technology, Rebecca has just faded at that point, unfortunately. Stuart, do you have a closing thought? Sorry, Rebecca, we lost you at that point.
No, I think I'd echo, as you'd expect, what my colleagues have said. But I think for me, it's all about goals. Products are neither here nor there. That's what we get to as a financial planner. It's understanding what people's goals are and what they were in February this year, Greg, and what they are now is definitely different. So they need to be revisited rather than just between Boxing Day and New Year's Eve.
Yeah, well, my observation in part back to what you've each said is that the obvious and direct parallels between personal financial planning and professional business financial planning, just as we are all having to figure ways of driving our businesses into 2021, building our pipeline, building new relationships, new business opportunities. So we should each be thinking about our own personal finances, if we haven't already, make sure that they are in order, because this year, as no other year, has shown us that you never know what's next around the corner. Our thanks to Mogers Drewett today, to our speakers, David Hill, Rebecca Beresford and Stuart Doughty. Thank you. Thank you for your time very much. Thank you also to the questions. If our anonymous friend wishes to make contact through the ether, please do. I'm sure Mogers Drewett will be delighted to talk to you. Please look out for that Bath Life Business Surgery, the next one I mentioned, which is Jan 20th with Juice Recruitment, and the Business Club on charities, a Christmas special on the 14th of December, so not long. And again, if your company has a professional service in any area of business that can help others, please do get in touch. It's a great opportunity to showcase that expertise, because we all need advice. We're in the same storm, perhaps just in different boats. Remember those Bath Property Awards nominations, and also the sponsorship opportunities in both Property Awards and Bath Life Awards. I hope this has been a useful session for you. I personally found it very enlightening and stimulating. It's prompting me to think there's a bunch of stuff to do, which I will at some stage honest. Good luck, good wisdom to all. This has been a Media Clash production, and this has been the latest Bath Life Business Surgery. Bath together. Thank you.